Hey guys, Dave Keller here with Market Misbehavior. Today we will answer the question, are the extreme breadth readings that we're seeing here in December 2023 bullish or bearish? So there's a lot of noise that's been made about breadth conditions becoming very overheated, and I think with good reason. While a lot of 2023 was all about the mega cap growth stocks, the Magnificent Seven, Amazon, Apple, Microsoft, Nvidia, Tesla types of stocks having really good periods during the year. In November and December, really coming out of that October low, it's been a much broader advance. The breadth conditions have really started to improve. Today we're going to show you a breadth indicator called the percent of stocks above their 50-day moving average. When we answer the question, is the extreme breadth reading that we're experiencing now bullish or bearish, and why? Before we get to those charts, I'd like to remind you, if you like this sort of thinking about investor decision making and sentiment and technical analysis of behavioral finance, do me a favor, like this video, subscribe to my channel while you're here. It would help me a great deal. And also, before we get to the charts, here's one more thing I want to tell you about. Today's video is brought to you by Seeking Alpha. I'm a big fan of places that allow you to better understand the market environment. I think seekingalpha.com is certainly one of those. When you go to the website, I would check out the stock screener, particularly because it allows you to use Seeking Alpha's proprietary quant model. In my experience working with institutional investors, we always had what's called an alpha model, or a quantitative model, which really modeled the characteristics of strong companies, demonstrating strong growth prospects and strong price momentum. Seeking Alpha does a really good job of taking that institutional level quantitative capability and putting it in the hands of individual investors. If you go to marketmisbehavior.com/seeking alpha, or just click on the link in the description below, you can go right to a special offer. If you use the link, you get $50 off your first year and also get a 7-day free trial to check everything out. So go to marketmisbehavior.com/seeking alpha. Now back to the video. All right, so we're bringing up this chart of the S&P 500 and the top panel going back for the last 2 years. Here we have the percent of stocks in the S&P 500 above their 200-day moving average, and at the bottom we have the percent of S&P stocks above their 50-day moving average. We're going to focus our attention down in that bottom panel and how that relates to the price at the top. By the way, as we're going through these charts, as you're thinking about what these breadth conditions might be, I would love for you to tell me, what do you think the S&P does in January, right? As we finish this November into December, very strong period. Do you see the S&P making new highs into January? Or do you see new highs as a mirage that will not be reached for quite some time? Drop a comment below and let me know. Now let's look at the chart here. So at the bottom you can see that as of today, and we're shooting this in mid-December, we're around 89%, almost 90% of the S&P 500 above their 50-day moving average. And actually yesterday we did close the day right about at 90%. So 9 out of every 10 S&P stocks, 450 out of 500 are above their 50-day moving average. Now, here's the S&P 500 in the top on a closing basis. The 50-day moving average is in pink. So literally, you can see the S&P is about 300 points above its 50-day moving average. Call that like 7-8%. So pretty decent move above its 50-day, and it broke above the 50-day at the beginning of November. So what this indicator is basically doing is it's looking through all 500 members of the S&P and making that same evaluation. Is the closing price currently above or below that pink line, that 50-day moving average? So obviously, almost all of them are above their 50-day. Now, I've heard a lot of noise, and I think with good reason, when any indicator becomes really overextended, when the markets has had a pretty good run, when any momentum oscillator or something like that gets really, really high, the natural tendency is to think, okay, this is a bad sign. And there is a justification for that. If you go back to the great literature on contrarian investing, something like Humphrey Neal's classic book, we have a link for that in the description below. Those are the sorts of things that tell you that when momentum or when sentiment gets to an upside extreme, you usually expect some sort of pullback. But here's the thing. Is this indication with the percent of stocks above their 50-day up to 90% bullish or bearish? I would argue both, and it depends very much on your time frame. In the short term, an indicator getting to this extreme level, particularly this one getting up to 90%, is usually a short-term bearish signal. It's a tactical sell signal. Look back just in the last year and a half, and you can see the previous 3 times when we've gotten up to 90% here in July, right before the July peak and the 3-month decline here. In late November, before the drop into December, about a 4-week decline. and then here in August before about we'll call it a 7-week decline into a late September, and then we had a double bounce into the October low. So, call that a, 7 to 10 week decline, I guess, in terms of how you want to measure it. And then we rallied, of course, after that. So think about what I just said. In each one of these cases, it is a short-term bearish signal. We're at 100%. We're 3 for 3 so far in the last year and a half, this indicator suggesting short-term rally. But what's happened after every one of those pullbacks? The uptrend has continued, right? The market has moved higher. So in the downtrend here, you can see in 2022, which again, I think we're in a very different environment with the S&P threatening new all-time highs, as opposed to when we're in August here, we're bouncing off of a new low. But overall, you can see that we had a little bit of a decline, but then we rallied, right? In October of 02, we rallied into the end of last year before really pushing higher through the course of the year. In late December, late November, we pulled back into the end of the year, but then rallied very, very, very well. And of course, after that extreme reading in July, we pulled back. And then, of course, have now made new highs for the year here in the last week. So it actually is both. It's usually a short-term bearish signal suggesting that this rally has probably run its course in the short term. But over the long term, it's often actually a pretty bullish sign. So the general way that I would think of this, right, sort of the default base case I would assume is short-term bearish, long-term bullish, to simplify. Now, the good thing about charts, one of my former analysts at Fidelity used to call charts the truth serum for the markets. A lot of times we have these market maxims. We have things that people just assume happen. What's great about charts is they tell you what actually did happen. You can, you have your report card right in front of you. You can run this indicator back for the last 20 to 30 years and actually see what's happened when the indicator has gotten to 90% before. So here I'm just looking at the S&P on a closing basis. I'm looking at the percent of stocks above their 50-day moving average. I'm bringing in a lot of data, so it's pretty noisy, so apologies for that, but I've highlighted it in pink, that 90% level. So really focusing in on when the indicator has been above 90%. In the chart above, I put a vertical line highlighting when that indicator has fired, right? And when have we gotten up to about a 90% level? So if you look back over, since the 2009 low, really, you will find that those two sort of realities play out very, very well. The two things that have tended to happen when you've gotten up to 90%, number one, a brief pullback. Now, sometimes there's been very little pullback. For example, in January of 13, we got to 90%, actually ended up going higher for about 4 months before the next high, which also got to the extreme reading. We had a bit of a pullback to the 50-day moving average. But most of the time, you'll find it's really close before a pretty meaningful drop. But the other thing is, actually, the market continues higher much further after that. So even though you have that short-term pullback soon after, the uptrend has always, has literally always resumed. The reality of equities, when you go over a longer-term time frame, there are very small numbers of observations, or much less common that the market's going down. In general, the history of equities globally is a history of a bull market because the global economy is growing, the population is growing, technology is making things more accessible and more, less expensive, arguably, but certainly more possible for humans to grow and thrive. And as a result, companies that have allowed, that are sort of creating that growth and enabling that growth, overall are growing over time. That's why the market capitalization in equities has grown over time. That's why the longer you zoom out of a chart, it tends to go from the lower left to the upper right for most equity indexes. So in general, indicators like this tend to be a good short-term reversal signal, suggesting that in the short term, we're probably due for a bit of a pullback. But in the long term, it actually tells you that the very long-term history of equities still seems to be alive and well. So what's interesting is we've gotten the signal now at the end of sort of mid-December, going through the seasonally strongest period of the year. November and December, particularly in a pre-election year, tend to be quite strong. January, February, March gets a little bit choppy, right, depending on how what sort of evidence you're looking at. So overall, what this suggests to us is that the rally that we've seen in the last 6 weeks coming off of that October low, overextended by any definition I would use in the technical analysis toolkit. I think this breadth indicator, percent of stocks above their 50-day, illustrates that beautifully. A pullback seems imminent given the history of this indicator and those extreme readings, but also the long-term strength of this market still appears to be alive and well based on that same indicator. What do you think? What's your take on the S&P and the possibility, or if not the probability, of making a new all-time high, getting above that 4,800 level from off the left side of the chart here, beginning of 2022? Do you see that as very likely or very unlikely? Drop a comment below and let me know. Don't forget to like this video and subscribe to my channel before you leave. I'd so appreciate it. For Market Misbehavior, I'm Dave Keller. Take care, and I'll talk to you again soon.